international partners. One of them is NUMA. We do a lot when it comes to education and event production. We're also launching e-residency as part of our collaboration with Estonia. We're going to be helping young entrepreneurs set up local legal entities completely online. If you want to be selling to customers and clients across the European Union. We also have 4 co-working locations with over 500 workstations and over 3,000 square meters of under management. So all of our resident startups will have unlimited free access to all of our locations across Ukraine and Moldova. And as we're also entrepreneurs ourselves, we successfully and sometimes unsuccessfully launch in-house startups. Back to you, Francis.
Awesome.
Oh, that's my slide as well, I think, yeah?
Yeah, that's okay.
Yeah, so just a few words. We have amazing partners. NUMA is among them, but we've had the pleasure of working with the likes of Techstars, 500 Startups, UNESCO, unicorns like Bolt, among just to name a few. And we've been cooperating with several government and government agencies such as the United States and USA, Swiss government, UK, US, Norway, Estonia, and Finland. And I hope I haven't missed Sweden. I haven't missed anyone. So we have a pretty broad scope of both public and private partners that we are always engaging through the course of our work. And now back to you, Francis.
Great. So I'm going to dive in a little bit into the Accelerator program that we are launching. And so in terms of the activities, there are a lot of touch points for support for companies. There's a weekly stand-up in a cohort where everyone's sharing their needs and challenges, weekly one-to-one with mentors that are able to answer and help you with your specific challenges. There are weekly lunches and fun activities like wine o'clock. So we also like to socialize. So week 1 through 4, the program is 12 weeks long, is broken up into different segments. We have workshops on things like project management, fundraising, startups versus scale-ups, design thinking, and events like our cohort kickoff, where you're first introduced to the mentor network, and an internal demo day where you get to learn about the other companies in the cohort. Then we have weeks 5 to 8. We really focus out on continuing to build out the business with things like startup valuation, sales assets, networking, pricing strategy, MVPs, market research. And then we have a breakfast where you pitch specifically only to VCs. And then weeks 9 through 12, we focus on things like negotiation tactics, how to build your team, sales stack automation, how to close fundraising rounds, which we'll also talk about today, and high value conversations with potential partners and clients. And then finally, we finish with a demo day that is targeted towards helping you raise fundraising, as well as getting your name out to potential partners, clients, and collaborators. This is a small sampling of our mentor network. It ranges from people that are experts in specific verticals like sales or marketing to those that actually work in large corporations that can talk about how to do sales and business with them, to investors that can help you with your fundraising strategies. This is our leadership team. So from the NUMA team, we have myself, our program director, Julia, and our program manager, Shai. And then from iHUB, you met Dimitri and Vadim. And without further ado, I'm going to introduce our panelists and our conversation this morning. So we have with us Paula Hubner. She's an early stage investor at La Familia VC, which is a network-driven fund from Germany that's investing across Europe and the US. La Familia's investment focus lies with technologies which enable or disrupt established industries. So far, key sectors of investment are insurance, manufacturing, logistics, and mobility. Paula joined the fund from a background in management consulting at McKinsey & Company, where she advised consumer good companies on operations topics, which is also her key investment focus at La Familia. We also have this morning Richard Koo. Richard is a passionate technologist and investor with DNX, an early stage US and Japan venture capital fund, and a member of the Draper Venture Network. DNX leverages its industry network and expertise in Asia, as well as the global reach of the Draper Venture Network to create tangible business development opportunities for its portfolio companies. Richard focuses on the fund's investments in retail, e-commerce, logistics, and fintech companies, and across all aspects of investment process, including sourcing, due diligence, transaction execution, and portfolio company management. Benjamin Ryder, who's also with us this morning, is an experienced venture capital investor with a multidisciplinary background. For the past 3 years, he held a lead operational role at principal at Startup Ventures, an early stage venture capital firm and accelerator in New York City. Benjamin has worked closely with over 70 startup companies from around the world, supporting them in all aspects of strategic growth. He has scouted and screened over 1,000 investment prospects from pre-seed to round A stage. And with that, I'm gonna stop my screen share and invite our panelists up. Wonderful, welcome everyone.
Thank you, great to be here.
So to start off, I'd love if each of you could just introduce a little bit about yourselves and talk a little bit more about your fund focus than I was able to go into. So I'll kick that off first with, let's start with Ben.
Sure. Hi everyone. My name is Ben Ryder. I'm based in Brooklyn, New York. And it's really great to be with you. Thanks to NUMA and iHUB for inviting me. So as you mentioned, Francis, my background is with Startup Ventures here in New York. And we were an early stage venture capital fund as well as an acceleration program, specifically targeting international founders and helping them adapt their business and transition to operations in the US market. So we followed an accelerator model, which helped companies learn what they needed to do in the US, so a training component, and then a warm intro component, and as a way to help companies reach both investors and customers. So right now I'm working on a new fund to be launched in Q1 2021. I'm very excited about it. It's going to focus on fintech and future of work companies at the early stage, sub $25 million valuations. And yeah, very happy to be with you today. I hope you'll get some actionable takeaways from this, and excited to speak with more Ukrainian startups.
Wonderful. Let's jump to Paula.
Great. Hi, everyone. I'm very excited to be here as well. Just a couple of words on La Familia. So we're a predominantly pre-seed and seed fund out of Berlin, but investing across Europe and also in the US from time to time. And our USP that we bring to our portfolio companies very much has to do with the network that we have. So both from just the network of our partners and of the wider team, but also the investors into our fund are very much people from the established economy all across Europe. So people like the families of Siemens, Miele, kind of the industrial companies, but also the automotive companies like BMW, Porsche, and so on. And then additionally, some of the big insurance companies, and our network goes even farther than that. But that's sort of what we try to bring to our portfolio by giving them access to mentorship, to people to help them on their advisory board, to customer access, and so on. So one example that recently happened that I think illustrates that really well is one of the people who's super close to our fund, Harald Krüger, who's the former CEO of BMW. So he was CEO until last year. He's actually now on the advisory board of Spread, which is one of our very, very early stage ventures. And they're active in the component parts space of automotive. So getting the input in from the former CEO and getting him to do the right introductions across the automotive industry is just invaluable to them. So that's what we really excel at. And that's also where our focus comes from. So we tend to invest in B2B companies where we can really leverage that network, because we see investing always kind of as a win-win. So we want to supply a lot of connections and help to our companies rather than just capital.
Wonderful. Richard.
Awesome. Thanks, Francis, and thanks iHUB and NUMA for the introduction to speak today. My name is Richard. I work for a fund called DNX Ventures. We used to be called Draper Nexus Venture Partners until we rebranded roughly about a year ago with the announcement of our third fund. And this is a $315 million USD investment vehicle from which we are actively investing from as we speak. DNX is three things. First is that we're cross-border, we're B2B, and we're early stage. So the first part is that we're cross-border. So myself and the US investment team, we make investments largely in North America, and then opportunistically Europe as well as Israel. And then we also have a Japan team that's making investments in the Japanese ecosystem. A topic that will probably come up later on today is sort of the cross-border synergies between various geographic regions. And it's something that we're quite passionate about as well. Second part is that we're B2B. And so we only focus on investments into companies that are selling into other businesses. So this could be large enterprises, Fortune 500 governments, and it can also be small freelancers, small mom and pop shops, SMBs. Usually falls into 5 categories for us: enterprise SaaS and cloud, cybersecurity, fintech, retail tech, and then frontier tech. Frontier tech is kind of defined as companies that are going after really, really tough engineering problems that may require up until Series B or even Series C for a full commercial model. It's 5G, autonomous vehicles, advanced chemicals. But I spend most of my time on enterprise SaaS, fintech, as well as retail tech. The last part is that we're early stage. So that means we deploy capital from 2 buckets. The first bucket is what we call the small check bucket. These are 50K checks that we can deploy relatively quickly with the hopes of getting to know the entrepreneur. So this is essentially a feeder fund into the core investment bucket. The second bucket is the core investment bucket, and these are 2 to 5 million, typically for seed extension to Series A. We're financial investors, first and foremost, but we have a very large contingent of corporate LPs as well, who have invested in the fund for both financial and for strategic purposes. The strategic purpose is more specifically to meet interesting startups that can potentially become partners, suppliers, acquisition targets for these corporate LPs. The type of corporate LPs really run the gamut in terms of industry. What they all have in common is that they're Japanese headquartered, but they have a global presence. So companies in the industrial side, banking side, retail side, advertising, and as Paula had noted earlier in her introduction, we also kind of leverage them, not just for a customer development platform, but also as a really, really important source for due diligence. So it's a little overview about DNX Ventures, and excited to speak more on this now.
Wonderful. And just quick before I continue to dive into questions, for all of the attendees, if you have questions throughout, don't hesitate to put them into the Q&A, and then we will answer towards the end of the panel today. Great. So to kick it off, what does the process of investing in a startup typically look like on your end from top of the funnel to the end? So things like, how are the decisions being made? What's being necessarily prioritized? What are some of those primary factors? And so I'll kick that off to you first, Richard, and then Paula or Ben, if either of you also want to answer, that would be great.
Sure. Thanks, Francis. I like to think that a lot of parts in business is best thought of as a funnel. So, for example, for the entrepreneurs that are investing, or the entrepreneurs that are on this panel and listening from abroad, when selling to customers, it's a funnel. For hiring and recruiting, it's a funnel. And for investors, it is also a funnel. And we look at many different startups at the top of the funnel, and then there's a second or third stage, and then there's finally a last stage where we then decide whether or not we're going to make an investment. And similar to any sort of customer acquisition funnel or hiring funnel, we also have a process of how to screen the top the middle, and then finally the end. So I can share a little bit about how DNX thinks about that funnel. And obviously I would love to hear about how Paula and Ben think about their funnel within their respective firms. But the hope here is that it'll kind of illuminate how VCs think about this particular process with the hopes that entrepreneurs can think, okay, this is probably what the VC is thinking, and this is probably what they're going to be thinking about next. So specifically for DNX, the first stage of the funnel has a very, very objective benchmark, which is, does this company's financing stage and industry, those two questions alone fit our investment theses? And so in our case, since we are looking at a B2B and early stage, those are primarily the two questions that we ask. And if that is not the case, then we quickly inform the entrepreneur that this is not a good fit. And then we focus then our times on the companies that do fit that criteria, B2B and early stage. I want to dig a little bit deeper into the early stage part. Even though we say seed and Series A, we as DNX also have pretty strict ownership thresholds. And so if it's becoming clear from the previous round valuations or even the size of the round that they're raising at the current round, and it seems that we are unable to get sort of the ownership threshold that we're shooting for, that is also a very, very quick sign that we are not going to move forward. Usually the second stage there is more of a deep dive into the product, technology, and the market. At that stage, we usually communicate to the entrepreneur that, you know, we are very, very interested. And then it's also at that stage where we usually try to bring in an expert network from within the DNX network. So this could be somebody from our corporates. This may be a former entrepreneur that was part of our portfolio. And you know, if we're lucky enough to have somebody within the firm that has specific experience in that, we also try to leverage that experience. Usually there's a few memos get written. You know, we ask the entrepreneur to open up the data room. And then at the very, very last stage, we have a presentation to all of the general partners within the firm. I would say for DNX, it usually takes probably about 3 to 4 weeks on average to get from first meeting to either term sheet or commitment to invest.
Awesome. Thank you for that, for the detail. Let's see, Paula or Ben, would either of you like to chime in? We'd love to learn also about how you guys make your decisions.
Sure, I can jump in very briefly. So right now I just have one partner, and first touch, we're just going to get your pitch deck, 15 slides or fewer, and I'll review that. If I have any follow-up questions before scheduling a meeting, I might ask some follow-up questions on email. Then we'll have our first meeting. Right now it's going to be a Zoom call. And then after that, if I'd like more materials, then I'll ask for a data room. So that's something that I'll get into, I think, at a later part of this discussion. But the data room's really important. That's going to have your financial projections. That's going to have a lot of other information for me to review with my partner. And together we'll determine, should we continue conversations? And usually there will be at least 2 more meetings, direct meetings, where we can ask questions and discuss further steps in the process. Then we're going to talk to your references, preferably customers who are using your product in the market. And that is very key for us because we want to see that validation. So you're going to need it both in the numbers and you're going to need testimonials to verify that. After that stage, we'll as Richard said, we're going to talk to experts who know this specific technology or industry to further validate it. And from there we can make a decision. So it takes a process that unfolds over time with multiple meetings.
Yeah, so I think, Ben, those are really good points about the references, because I was going to emphasize that as well. Maybe just a really brief overview of the way we do it. We, of course, also think of the process as a funnel. And what we tend to do in terms of meetings, because we're an investment team of around 7 people, and we each kind of have our industry focus, but whenever we get closer to a positive decision, we have one team call where our whole investment team will be present, even the people on the team who are not specifically focusing on that segment, just because we believe that there's someone with domain expertise on our team who will kind of take apart the fundamentals and put it all into context of the industry before bringing it to a stage further down the funnel. But after that, it's very helpful also to get an outside perspective, just like, does this make sense overall? We also love to get everyone's view on how they like the founders, and just sort of, there's a big personal component from my perspective to early stage investing. So we like to have the whole team present. And then the final step, which I don't think was specifically mentioned, is sort of the investment committee. So that will be where, again, our whole team has usually about 1 hour, maybe an hour and a half, where we discuss a company at length along dimensions. So we'll have dimensions like team, traction, and so on that we go through. At the end of that very in-depth discussion, there's usually a vote where everyone has a vote that we can that we collate. And what I think is really key, at least in our process, is that there's at least 1, maybe 2 people from the more senior part of our team who are really pushing for it. And if the rest is like not in a consensus, that's also fine. So maybe helpful to know, you don't have to get full conviction from absolutely everyone on the team. It's sometimes it's good to have different opinions, but someone needs to really, really believe in it.
I think that's really helpful insight. And to add on that with our next question, what do you prioritize when deciding whether or not to invest in a certain company? And you mentioned a little bit before, Paula, about traction or team. What are those things? Like, what type of traction do you like to see? What matters to you in a team? And so, like, what are actually those prioritizations when you say yes to a company?
Yeah, so I think, or no, no, I think, I mean, you can always say it depends a little bit, of course, on the industry and the type of team. But if I were to summarize it, I would say, since we're at an early stage, in that case, pre-seed and seed, we really try to optimize for strength of the team first, second, the market and how that product and that technology is tackling the market, and then traction last. I would say it's traction is not a tiny percentage of the decision, but I would put it in that order, just because I think as early stage investors, it's our job to think in that order. Later investors will kind of reverse that order more and more, step by step. So in Series A, your traction will be more and more important, and the role of the team will, of course, still be strong, but it's kind of the earlier stage investor who will have checked more on the team and done more of those reference calls. And then, of course, in Series B, C, like your traction and what your customers say and what you can see in the market becomes so important that, of course, that's going to overweigh. And maybe just taking a little dive into those 3 dimensions, I think team is obviously always going to be central, because in order to win in any market, you're going to have to be kind of the #1 team that we as an investor believe in most in that segment. And that includes great background, domain expertise, so having certain knowledge specific to the topic, and then also having like a unique insight of some sort. So we always look for companies who can tell us why they've understood this market better than anyone else would have. And that can come from domain expertise, but that can come also from some sort of a network component. Another one that I find important is team complementarity. So just different roles, it's not all the kind of same profile. And then one thing we always discuss in our investment committee is the like kind of conviction on like the charisma of the people in the team. And this does not necessarily mean you need to be like a circus master salesperson, not at all. The question is more that we always do a little survey in the team of would you work for this person? Because we think it's so important. If they are going to hire top people in their team, then all of us on the investment team should say, yeah, I could imagine working for them. Or at least a few of us need to really, really strongly believe that, because you can be incredibly intelligent and have a really good market idea, but if you're not going to be able to hire all the best seller people at the start, obviously later, if you're a huge brand, then it becomes easier and it doesn't depend on the founders. But at the start, it's really, really going to depend on them. So that's actually a vote that we go through. So maybe something to think about before taking investor calls, like what really makes us stand out in terms of being charismatic, really like having pull to people, and maybe your charisma comes from you just have all the best intelligent answers to your specific part of the business. Yeah, so that's just kind of what we look at on team. That being said, I think what we've been seeing more and more in really, really bad markets, even a great team will not succeed. So the second one will always be the market. How big is it? How many people really have this problem, and are they willing to pay for it? I think on this piece, like, we ask the very simple questions. It's not a complicated formula. It's more like, is this market big enough, or is this segment they're going for so underserved that it would be interesting? And maybe one anecdote here. We recently looked at a company where they were all like these amazing profiles from like senior leaders in a unicorn company from Europe, and they were starting something new so it was from the travel industry, the original company, and the new company was roughly also in the hospitality space. But the specific space they chose was, from our opinion, like looking at the buying center, so terrible that we kept talking to them because we were like, this team is amazing, but the market was so bad that was so unclear to us and anyone we talked to in terms of references that we couldn't go for it. And then last one, just quickly, sorry, I've been monologuing here. Third one, traction. So of course, a great traction is going to be something that stands out. I think we look at B2B mostly. So for us, it's usually about how strong was the conversion to full license deals, what's sort of the split between recurring revenue and more like a consulting service revenue. So we always want to see growth in the recurring part. And tying in with what Ben said earlier about customer references, I think it's always better if you have a few customers as like full license customers already, who are great advocates to your company, who themselves are kind of very smart, inspirational people who will really be able to genuinely sell you to the investors as well. So I would optimize for that rather than having loads and loads in the pipeline at an early stage. And then I think on top of that, and this works for B2B and B2C, any user data that you might have that's about kind of monthly active users and so on, that's always something at the early stage we look for. So even if you don't have a lot of customers, if within your customer the user metrics and the stickiness seems to be good, then that's something that really drives the needle for us.
Wonderful. Thank you, Paula. Thank you for breaking it down, also the different buckets too, because I know that's something that founders have a lot of questions about, like what actually kind of traction matters, what about the team actually matters. I love the question that you ask on, would I want to work for this person? Richard, do you have anything to add?
You know, that was an excellent breakdown. Not much more to add to that, other than maybe one other point, which is, you know, we talk about, or as Paula had mentioned about founder company. Why is this particular entrepreneur the best fit for this particular company or this particular market? So there's founder market fit. There's also product market fit. Why is the particular product that you're developing the best product for this particular market? So there's all these different types of fit, right? But the other one that I think we as investors also think about is investor company fit. Like, why are we the best investors for this particular investment opportunity or this particular company? And I differentiate those two, investment opportunity and company, because you could be the best fit for this particular company maybe a year from now when the company grows to a much larger stage, or you could be the best fit for right now. Maybe you are the best fit for them right now, but maybe not 1 year from now. And so, you know, we also think very, very critically. And in fact, in our investment memo, we have an entire page dedicated to like why we as DNX are the best fit for this particular investment opportunity in this particular company. And the reason why that's important is because I think there are so many investment opportunities out there, and we have to be very, very critical about like why it is in the best interest of the entrepreneur to take our money and for us to deploy this capital to this particular investment opportunity. And it also helps us think about how to be more competitive in the venture market space. If I'm being sort of brutally honest here, venture capital dollars is largely commoditized. Whether you take $10 from me or $10 from somebody else, it's still $10. But what is the real incremental value add that we're providing on top of that $10? And that's kind of that section of the investment memo where we have to think really, really critically about that. Is it our past portfolio company experience? Is it the corporate network that we're building? Is it the personal connection that we've developed with the entrepreneur on a very, very qualitative basis? But I think that's kind of where we also need to think very, very critically. And if it just turns out that we have nothing that we can add to the table other than capital, then we may pass on that deal.
I think that's such an important point, especially, I mean, we do that when we're selecting companies for NUMA as well. It's like, yes, we want to be selecting really great companies, but it's also like, are we the right fit for them? Can we actually help them? I think is a really important thing to think about. It's not just about the capital. And Ben, to get to you, what are some of the common mistakes, that you've seen founders make in the fundraising process? Like, what are some of those big don'ts that maybe you've seen?
Sure, this is actually my favorite topic. So I could talk about this for an hour, but I'll just distill it down to my top points and the things that I've seen. So, and by the way, Richard's answer was a great answer regarding finding the right fit. So that's one of the key things that I emphasize at the early stage. It's super important. So you're looking for a partner, whether it's an investor, an accelerator program, could be a co-founder, an employee, a channel partner, always looking for a partner that is the best fit for you. So that's key. Common mistakes, taking capital wherever you can find it, as Richard said, very taking dumb money or just taking capital without value that comes with the capital, strategic value. So you really want to find good partners. The other thing would be not researching the US market enough. So not understanding the US market if you're coming from abroad, or on the opposite end, thinking that you know it very well without really knowing it. So if you've never been here, if you've never experienced it, just making assumptions that you know it. So in other words, being overconfident about your knowledge of the US market. You need to show flexibility and willingness to learn and do some trial and error. The other thing that I've seen a lot is talking too much when you pitch. So just like not stopping and giving the investor a chance to make it a natural conversation and to break in when they have a question. So you're trying to do investor discovery in the same way that you do customer discovery, understanding what the investor is looking for and why you're a good match. Another thing is having unrealistic growth expectations. So telling me that you're going to be $1 billion company within 2 years, it's probably unlikely. So try to be realistic with your projections. And even more important than that is to have solid assumptions in your financial model. So there's one of my contacts is a prominent investor in New York City, and he always says he asks founders to send him the financial model so he can tell them why it's wrong. But he doesn't. That's not why he wants to see it. He wants to see it because to look at the assumptions that are behind the model and to assess them. The biggest mistake of all is trying to be stingy with the terms after you find an investor who's a great fit for you. So you don't want to do that. You want to be fair, but you don't want to haggle too much or bargain too much back and forth about terms, especially at the early stage. So you can negotiate, but don't go overboard, because when you go overboard, you're showing an investor that you don't really value them as a partner. So I've seen it cost companies deals by just trying to negotiate too much. Don't try to raise too little money. So you don't want to under budget. You want to make sure you have at least 12 to 18 months of runway. And that's very clear. And you also want to communicate what milestones those funds will help you achieve. It has to be really clear. I can't tell you how many slide decks I've seen that don't have that figure in there. And you want to communicate, will it help you achieve a certain number of users or a certain amount of revenue? And then the last thing is that sometimes founders don't take into account the cultural differences when they're doing their fundraising, and the founders that are on this call from Ukraine will have their own set of cultural challenges when communicating with investors from other regions. So I've seen that a lot in terms of not responding to investor objections or being too accepting of investors' pushback without trying to work through it. So you want to overcome the objections without what we call in the US a hard sell. So you don't want to be pushy, but you want to really communicate that you want to make the deal happen when you find a good partner, and you want to address the objections or the doubts that an investor may have, and really take it through the process. So in a program like NUMA, you'll learn how to understand the cultural differences and overcome that challenge. So those are the most common mistakes I've seen.
Wonderful. Richard or Paula, do you have anything quick to add before we move on to the next question?
Yeah, I have like a few just very quick ones. These are very tangible, I think, but not as in-depth as Ben's. So one thing I've seen changing your story along the way, where founders in different calls have like a slightly different story they're telling or way they're explaining their product, where you can notice like, oh, they got some sort of feedback and now they're like completely changing it. I would always optimize for having your story straight beforehand and sticking with it. Obviously, as Ben said, adapting to the questions and the things that the investor is looking for, but without like changing kind of your DNA. Second, just really short one, reading out slides. So just reading through a presentation in a pitch, I think is a huge don't. And then another one is, if an investor has either somehow ghosted you, which is absolutely bad behavior, I'm not endorsing that at all, but if they're ghosting you or have sent you some sort of an email telling you that they're not going to invest in this round, I think like a common mistake is kind of still pursuing that relationship and like writing additional emails, like trying to kind of sway the investor. Usually those sorts of decisions are kind of final for that round, and I would then rather optimize for having maybe sending an update in the next round, or having like a quick 10-minute feedback call with the investor and just saying, hey, would love to just learn from you, and maybe also give them some feedback, what you liked about the interaction, ask for buy-in to contact them at a later point.
I think that's great advice. Wonderful. So to get to the next question, how do you build quote unquote heat for the company before the raise? So in terms of their fundraising strategy, what are some of the steps that a startup should take before they fundraise? And, how can they go about building a strong network of investors? And Paula, I'll kick this off to you first. And then, if Richard or Ben would like to chime in, and then we'll get to Q&A.
Awesome. Yeah, so just going to try to keep this brief. So one is what I just mentioned. So I think when maybe at the end of one fundraising process, some investor doesn't work out, I would keep the ones that you really like the interactions with in your network, but without sending them maybe like a weekly update, which I've also seen, but more kind of getting the buy-in one time to send them updates, and then maybe send something every 2 to 3 months, and actively contact the ones you really, really thought were strong, where you also felt a mutual connection in your next fundraise. But of course, kind of when you're first going out, I think it's probably a good idea not to talk to too many investors along the way. So like when you're not in your actual fundraising process yet, and you haven't clearly defined the message and the stage, the amount of funding you're going for, I would kind of keep the ongoing conversations to a minimum, unless it's an investor you somehow have a personal relationship, or where you have that contact already and you feel comfortable having an informal talk. But otherwise, sometimes it can be good to hold off on those, and maybe even say no to some of the conversations with investors, because that way it's always good if they have to put a reminder in their calendar to contact you in I don't know, 1 or 2 months when you're really ready with your story. Plus, at least in the Berlin ecosystem, I don't know how it exactly is over in the States, but in Berlin, if you're an interesting company, you're fundraising in 1 or 2 months, and you've kindly declined the conversation with a couple of investors, that like circulates very quickly, and you'll soon have probably a few more requests to talk. So that's at least how it works here, just because everyone knows each other. It's a very close-knit group. And then, of course, always get kind of all of the intros as personal as you possibly can, either through your angel investors, through other founders, or through an incubator program, for example. And then I think just the last thing I would always think about is define your story very clearly and try not to change it for any of the investors you're talking to. So one example, a portfolio company of ours recently was contemplating their next round, and there were like several different options of how much they would raise and at what point in time. And they went back and forth like with us as their current investors a couple of times before going out and talking to anyone, because I think what's always problematic is if you seem a bit like inconsistent in how much money you're raising, or if in the end you can't actually fill your round. So sort of have that story straight before talking to anyone, unless you have that personal relationship and it's an informal conversation. Yeah, that would be just my quick tips on that.
I love that, and I love how you talk a little bit also about like that, the almost like power dynamics, where if you say no to some of the investors, it attracts more interest. We have one of our mentors that uses like some of those strategies when he's raised for his own company. So I think it does work somewhat similarly in the States. Richard, Ben, do you either have something to add to this, and then we'll jump into the Q&A?
Yeah, I can just add something briefly. As Paula said, warm intros are the best. So always look to connect with someone through people that you know in your network. And just two additional things. The networking with investors will be the same as any other type of networking. So you want to find something in common with the person. And because investors, as with anyone else, like to talk about things that they know that they're involved with in their industry. So if someone's in space tech and you're in space tech, use that as an opening way to introduce yourself and just say, I'd be happy to discuss with you what's going on in the industry. And the other thing is try to add value in the interaction. So if offer your advice, offer your expertise. I was looking at a company in space tech recently, and I was able to connect with a founder from another industry who was an engineer who offered to help me with that company to look at this technology and give me advice about it. That's what I love. So if you offer to add value to the relationship, that's a great way to get the ball rolling and to move things along.
I love that. It's like investors are people too. So you would build a relationship like you would with anyone else.
Yeah, treat it the same way. Yep.
Yeah. Rich, do you have anything else before I jump into the Q&A questions?
No, I think Paula and Ben did an excellent job describing all the things. So I think we can.
Perfect. We'll dive in. So we have the first question from Andre. So he asks, how actively do your funds invest in startups with a service business model or service delivery, providing services in the agriculture sector using unmanned devices? So agritech as an example. Do any of your funds invest in those types of companies?
Yeah, so I can take this one. Andre, thank you very much for that question. To answer your question, yes, we do invest in ag tech. It's an area that is, despite being probably one of the most mission critical industries in the world, i.e. we all need to eat something, it is still an industry that is very late to technological development, to disruption. And so we, as a firm, are very, very bullish in terms of ag tech. I think your question really more is around investments into services businesses. This one I think is quite polarizing. I think some investors believe that at an early stage, because of the scalability of a self-serve product, it's often not self-serve. Sometimes you have to do some integration work. Sometimes there's a lot of customer success related to it. But having a services component is not good, because services typically mean lower gross margins. Right? When you think about a gross margin of software, the only sort of, so to speak, COGS is data warehousing costs. And then of course you got SG&A, which is engineering costs, R&D costs, sales costs, and so on and so forth. But the gross margins tend to be quite high. Usually what what I look for in SaaS businesses are 70 to 80% gross margins. When the sales business, your gross margins could become very, very high. Well, you actually have to change the structure of your P&L itself. And so as a result, the scalability of like the top line becomes much, much harder to do. But that's a more theoretical exercise. In reality, actually, services is what is often expected from the customer side as part of a package with the product. We usually do it on a sort of a case-by-case basis, and specifically as it relates to ag tech. I know from personal experience that services is a huge component to it, because oftentimes these product deployments are done over multiple hundreds and hundreds of hectares of space, and this is not just a install the app and go. This is a huge, almost a system integrator level type of integration. So without knowing exactly what, Andre, your product is or your services is, I would say actually specific to ag tech, we do see a lot of product and service bundles. But I would not say that's applicable to most other industries.
No, I think that makes a lot of sense, because I know investors are often looking for scalability and being able to have those big margins and those returns. Great. Thank you, Richard. So the next one is from Evgenia. What are startup obligations to you in case of investment? Should it provide some part of its revenue to you? Who would like to take that?
Sure.
I'm gonna go with Paula.
I'll maybe start this one and actually, Paula, you're welcome to take it if you want.
I'd have a counter question. What exactly do you mean? Do you mean by providing revenue to the investor? Do you mean like kind of the investor getting some of the revenue, or what exactly do you mean? Could you clarify? Unless, Richard, it was totally clear to you what she meant.
If I understand the question correctly, I think the answer is no. I don't think under any circumstances should the investor at the stage at which we're largely discussing right now, for them to be asking a portion of revenue. I think that's a very, very different type of asset class, and oftentimes it's not even based on revenue; it's based on EBITDA or it's operating profit or something like that, and not revenue per se. I think that the one exception to this is very, very rare edge cases where you have a corporate venture capital firm have some kind of term as tied to the investment itself, with the expectation that the corporate and the startup is going to do a joint venture on some product. Those might be instances where there might be a tie between revenue goals and equity. But I think if you're largely raising from institutional capital, this is largely unheard of.
So the question is clarified. The question is formulated in the wrong way in terms of it's more about how much of a company you usually take. So the obligations of like what percentage of a company are you typically taking?
Yeah, so I would kind of frame it from the other end and say for any given funding round, especially if it's pre-seed or seed, so the more early ones and probably Series A as well, you usually don't want to dilute in one round more than 20, maybe 25%. So I think that's kind of where I would start. So and why is that? Because for you as well as from the investor perspective, you always want the founders to stay relatively strongly in control for as long as possible, because that incentivizes them, especially at the beginning, to really grow the company and have sort of all of that ownership, and that's my baby sort of feeling. So that's also something whenever founders have like diluted too much too early, that's usually for us kind of a red flag because of incentivization. That being said, at any given round, if you dilute between 20 and 25%, and that then kind of dictates how much each individual investor will take, right? So let's say you're raising $1 million at 20% dilution. then depends a little bit on how you want to structure it, whether you want to do one lead investor who does 1 to 1.5 million and then maybe fill the rest up with angels. You can do the math on how much each investor would take, but that would be my advice in terms of how much you would want to give up. And of course, depending on how much you need at that point in time, that then of course gives you sort of the typical valuation of those stages.
I think that's helpful to know. We've definitely interviewed companies for NUMA where, you know, the investor might have 50, 60, 70% of their business already, and that ownership then sets them up for not being able to raise subsequent rounds. So I think it's important for startups to have those types of things in mind. Great. So the next question is from Vitaly. So he said that most investors that he's contacted want to see traction, whereas he says he needs angel investment only. And they seem to ask me to show them that I don't need them. What may be wrong outside of my contacting the wrong people? So like in terms of like him trying to find the right investors, do you have advice for that?
Well, I'll just start out by saying it's always the most difficult to find an investor when you don't have any traction. So if you just say, I'm working on something, it's pre-revenue, I just need your money, that's a much more difficult sell than compared to something that's out in the market and has validation with customers. So I would start by focusing on the specific industry and trying to find people around that industry who are most interested in supporting a technology coming from that industry. So I was working with a company in HR tech, and that person has similar challenges as described in this question. And the key for her has been connecting with people within that HR tech industry who are familiar with the problems and see this as a viable solution and would be interested in investing. So that would be the advice I have for that.
Great, thank you. And so we have another question, I think on sort of social media platforms. Is it possible to send, you know, a challenge to Facebook or any other giants in social network marketing in this current day and age? You know, he said that maybe many investors are afraid to, you know, challenge those big giants right now. You know, what do you think about that? And so in terms of like going after heavily prevalent industries like social media.
I'm happy to kickstart that one off. So from our perspective, I mean, we don't really do B2C, but we have seen a few sort of social platforms, or at least B2B models that were very highly dependent on the big platforms. So I would say in general, if it was a model that was directly challenging Facebook, from my perspective, probably a bit of a difficult case to argue. Also, given that like one of our theses is the next kind of wave of innovation in that area will come more from democratizing and opening the platforms to or opening the scripts so that they become like the kind of content becomes more democratic, and the Facebook that you see changes for you. So kind of taking some of that power away. That being said, I think there's some models in social media which are still kind of open, where you can kind of say it's a chunk of what people are doing on Facebook now that you could still solve kind of in a niche market. So I don't think the social media market in itself is completely kind of dead, but if you're going directly for Facebook or Instagram, I would probably be wary of the story.
I think that makes sense. We have another question that's on, you know, how should people, like, thanking you for your answers, and then how should people get in touch with you or your fund? LinkedIn potentially?
Yeah, actually, maybe this might be a broader discussion about like how to reach out to investors. I mean, I think it differs for everybody. I personally rely most heavily on email. So I don't really check my LinkedIn as often as maybe I should. I don't check my Twitter as often as much as I should. But I think at least for me personally, I rely very, very heavily on email. And happy to put my email on the chat later on.
Great, that'd be wonderful.
Yeah, and I think, but you know, I also do hear of entrepreneurs who use Twitter as a way to reach out to entrepreneurs or to receive pitches, LinkedIn, Slack groups.
Wonderful. And Paul, Ben, what's the best way to get in contact with you?
I'm a LinkedIn person.
Oh,
yeah,
nice.
For me, LinkedIn. So feel free to connect, and we'll take it from there.
Wonderful. Yeah, I'm really bad also about checking my LinkedIn. I usually just give people on LinkedIn my email as well. Well, wonderful. Thank you, Ben, Richard, Paula, for being with us today. We're going to wrap up. We have 2 minutes to go. If any of the attendees would like to get in touch also about the NUMA iHUB program, our team is available to schedule 30-minute calls to speak with you more, learn about your startup, and see if it might be a fit. So thank you again, everyone, for coming. And I hope you all have a great rest of your day.
Thanks.
Bye. Thank you. Bye-bye.